Hello, everyone, and welcome back to another episode of our podcast, The Real Estate Talk. I'm Durid, joined by my brother, Leo, and today we're diving into a topic that's really crucial for every buyer that's trying to buy a home. It's mortgages. And we're not just scratching the surface. We actually have our go-to mortgage expert here in-house. He's gonna break it all down for you. You don't wanna miss this one. Leo?
Well, thanks, Durid. Actually, I'm really excited for this conversation we're going to have today, but I'm excited as well for the new twist that I'm going to tell you about, guys. From now on, in each episode, we're going to have something called the interrupter. Either me or Durid, we're going to have this power. The twist is the interrupter will have the magical power to interrupt the guest and without feeling guilty, to interrupt it, and by using this ring in here. That's my interruption.
That's right.
And the catch is you have only 5 times to use this power, not more than that.
5.
So better you choose your moment very wisely. So every time we're going to ring the bell, I will be maybe the curious buyer or the concerned seller or just a nosy person who want to have a question. So we create this rule just to make it more clear and less complex and more understandable for everyone watching us. So everyone cool with this?
It's cool with me.
Cool.
Okay.
Depends on how many times you do it.
Interrupt me how many times you want.
It will be cool.
I'm glad you set rules, though. At least
It's a
max
rule.
5.
Just 5.
If you didn't get more than
I'm going
5.
to take it away from you guys.
Just 5 times. And believe me, this is my right. I'm going to use it very well.
I don't like to be interrupted, but it's all right. Just for 5
I
times.
don't mind.
Okay,
I actually
fine.
prefer you guys ask me the questions. That way it makes it easier for me
That's
to
right.
just
That's
give
the
the
standard.
answers.
That's right,
you know?
100%. So moving back to our special guest, Jorge, why don't you tell us a little bit about yourself and how long you've been in the business?
So George DeFoss, I've been doing mortgages since 2002. So pretty long time. I've seen the good, the really good, the bad, the ugly, and then the really good.
So you've been in the business for like 22 years?
22 years.
Wow.
I even saying it, now I think about it, I'm like, wow, it's 22 years.
When did you start? 5 years old?
So probably.
Well, it ages me a little bit, but I'm still not going to.
So 08, dot-com bubble, all of that.
All of it. I've been doing the
I
mortgages.
didn't know
and,
that
yeah,
old. I thought
yes.
I knew he's a veteran,
Yes.
but not that old.
Yeah, so
Well, good for us.
Yeah,
Good for us. We're
Again, good
gonna-
for myself. It was something that just interested me from very early on, and I thought it was just great how the keys to any home loan is us. It's real estate. It's mortgages. It's the
agree.
person putting together possibly one of the larger investments that anybody's going to make.
No, I agree with you. And now when people listen to you and see like 20 years or 22 working in this business, they will think your business is really fun.
Right.
But I don't think this is the case. It's not really fun.
Well, it tends to be. It really does. There are always good times, bad times. That you go over things with customers and make sure that they understand that there's a process behind it,
Correct.
and we got to make sure that we give it to them as easily as possible because they're not in this industry. They don't know everything that's going on the back end, behind the scenes that we have to go through. The amount of hours that we put in to be able to make sure that you get to the finish line based on your contract date. And
Right.
certain criteria that need to be met by the bank, by the real estate agent, by the title company, by the appraisals, by the inspection companies, by the insurance companies, and if there's management companies, even then.
So much pieces going together, right?
Too much.
So it definitely takes a village.
So was that all? Yeah, that's actually one of the main words. It takes a village.
It does take a village.
It does.
To go from under contract to closing.
Oh, absolutely.
George, was that all in Florida, your experience?
Always in Florida.
Always in Florida.
I bought my first place and I was 21 years old.
Wow.
And I thought to myself, I started looking at everything and I was like, the amount of documents they asked me, the amount of paperwork they asked me, is like, wow, there's a lot of things that I didn't know actually came with wanting to buy a house. I thought it was like you buy a car. Hey, I want to go buy a car. If my credit's good, I get a car. If my credit's bad, I don't get a car. But it takes a little
It's
bit
not
more
that
than
easy.
that. It's
Most
not
of
as
us
easy.
think this way nowadays. It's especially buyers. They think it's really that easy, which it can come streamlined if someone is reaching to the right lender. Yeah, it can really be a
It
streamlined
can be.
one.
There's always, as long as the customer understands that what we're trying to do, we all have the same goal, to get you to your dream home, to get you the keys to your home. So we work together from beginning to end it does work out. You can make it very easy and very much fun, for the next time they're going to buy.
Well, ask me about it. Every deal that we do and you're involved, that gets fun. And it gets really smooth. I can give you that.
No, I agree. And let me add to that, we've been working with Jorge for a long time. We have him here. Thank you for being here, by the way. And we were been working with him for a long time. And because of all the smoothness in the transaction, I really appreciate him. Thank you. Thank you for always working with us.
I try to make sure that, the customer doesn't want I don't want the customer to have a bad experience. It is a little bit stressful, so I try to ease as much of the stress as possible by taking on, just making sure they get everything they need in order, to get to that point.
Agree. Hit him was the first question.
Jorge.
Hit him.
Without further ado.
You're gonna. I was waiting for this. I was like, this sounds too easy, too good to be true.
Let's get the benefit of Jorge.
Come on. What did you want to ask?
Without further ado, let's get right into it. We're in Florida.
Mm-hmm.
Some people might not know what that means, but you being in Florida for all that long, I've been in Florida and I've seen that, I've been there. Can you tell us why Florida is really different beast?
Well, one of the main things that a lot of people, obviously it's Florida. You have the sun, you have the weather, you have great atmosphere, the beach. So it's a highly sought after area to want to live. Okay. But with that also comes what people hear. Oh, property taxes are high. Insurances are high. Well, property taxes are high because a lot of people don't realize it. We don't have state income tax.
Correct.
So a lot of people forget about that, and they go, well, you don't have state income tax, so they have to hit us somewhere. They're going to hit us on property taxes. Insurances. We do have one of the higher ones, in the whole United States. It has to do a little bit with the amount of carriers we have, which hopefully in the next couple of months should be changing. It has to do with, obviously, the amount of coverages that need to be in place, such as wind, hazard, flood.
I heard they're approving new lenders.
Absolutely, new insurance companies. Yeah. Yes, absolutely. That's what we're hoping. We're hoping
that will change the game because
and most of these insurance companies were here before. Before Hurricane Andrew, before Katrina. They were here.
No, we totally need this. We totally need
absolutely.
This. And if you go back a little bit about the trend now in Florida, what is the interest rate here? What is the amount of the loans we're getting, the max? What is the best loans?
So the max loans, there is none. Remember, you can go up to 20 million to 100 million. That's really not, there's not a max number. Now, if we're talking about basic loans like conventional loans, FHA, VA, which is the normal loans. Well, VA and conventional, you're up to 766, 550, at least in this Tri-County area. Broward, Miami, West Palm.
So that has to do with the location?
Yes. Okay. Certain counties have different loan limits for FHA. Okay, that has to do with FHA. If you're talking about conventional and VA, you can go up to 766, 550, and with VA even gives you the ability to go a bit higher as well.
I can again. I'm so happy using this. That's so cool. Can I do it one more time?
Don't. You didn't say anything.
I didn't interrupt you.
Absolutely.
I waited to the end.
You're just trying the bell.
No, I'm going to interrupt him. So, as an average buyer, I don't think average buyer know really what's FHA or what is the VA. Like, what is this words?
Okay, so FHA, Federal Housing Administration, VA is Veteran Affairs. So VA is a loan designed for veterans. That's it's actually the best program out there, designed for our veterans. We want to thank them for their services. They give them the better interest rate, no money down if they want to. They can go even in with as little as zero.
And what is the convention? What is the difference?
So, and then we go to FHA. I'll go to FHA. That way we go up the line. So with FHA, it's Federal Housing Administration. It gives you the ability to put very little money down, as little as 3.5% down for first-time home buyers. Okay. With conventional, you're able to go with as little as 3 to 5% down, with the ability to put more money down if you want to avoid mortgage insurance, which is the PMI.
Okay. So So we go back to FHA and VA. Those are government loans.
Absolutely.
Now, one of them is different from the another because both of them are government. But what's the difference?
Yeah. So again, with VA, it's only designed for veterans. You can only be a veteran to be able to get that VA loan. Okay. The best part about VA, like I said, one is 100% financing, so they don't have to come in with any money for down payment.
Zero cash to the closing table.
Zero cash for down payment.
Okay.
Remember, there's always closing costs. You have title company fees, recording charges, taxes, and
Exactly.
insurance. Right.
We'll back to the interest rate. What is the interest rate today in Florida?
Rates right now for a VA borrower, you're right around 6.8, 6.9 fixed rates. So they give you a little bit better rate. And the best part is about VA is that there is no mortgage insurance. There's no extra insurance for putting so little money down or no money down.
Unlike FHA.
FHA has also lowered their numbers on mortgage insurance. We're down to 0.55, across the board. Doesn't matter what you put as a down payment, whether it be 3.5 or 10% or 15% down. And actually it goes down from 55 to 50 for mortgage insurance. So it's 0.5%.
So let me touch on something here. Like the interest rate is a big thing for everyone.
Absolutely.
Everyone's saying like, no, I'm not going to buy a home today because interest rate is so high. Usually I tell people like, if you don't know, but one time back in the time, that it was like 14, 15, 16.
Absolutely.
So compared to this time, 7 is nothing or it is nothing.
And that's what a lot of people forget. A lot of people forget when I talked to my parents when I was getting into the industry, well, their interest rates were 18, 19, 20%. And they thought that was normal interest rate. And that was normal for that time. We're talking about in the 80s, in the 80s and 90s.
20% is a lot.
Right. And 20% is a lot.
Talk about complaining.
And these are regular, and these are not, and we're talking here and we're like, wow, that's a lot. But those were regular rates back then.
Not even high.
Those weren't even high. High was 24, 25, 26.
You're kidding me.
No.
That is
not
24 at that time?
That's like credit card.
Yep.
That's like credit card.
Yeah. So these rates, and even before 2002, the rates were still in the 10s, 11s, 12% interest. Again, we're talking about normal rates.
Okay.
It wasn't until 2003, 4 where rates started coming down to great rates at 6s and 7s. And I say great rates back then because those were unbelievable rates back then.
Correct.
But now people think, those are high rates. Those are not high rates. These are the rates where we've always needed
because
to
they're
be
looking
in.
for the pandemic time when the rate was almost zero, like 1.9.
Right, free money.
I believe that was a record, though.
It was the lowest it's ever been. But again, if you go back maybe to the 1940s and 50s, that's possibly that's where the rates were. So those people that say, hey, we're going to wait till the interest rates go down. Well, you're not going to wait 70 years to get down back to 2s, 3s, and 4s.
Years to buy a home.
All you need, even if the rates go down 1%, that's what a lot of people don't understand. Rates go down 1%. Now you have an influx of more people jumping right back into the market.
Right.
And we're talking about 1%. So that means going from 7 to the 6s, or going from 5.8 or 6.8 to 5.8.
So do you think interest rate going down?
Oh, absolutely. They'll go down at some point or another.
Is it going to go up before it goes down?
Right.
So that's the big one.
So we definitely know that rates are going to come down. Now, how long is it going to take? That's the part nobody knows. That's the $1 million question.
That's the crystal
if we
ball.
knew, we'd be billionaires.
I wish I know.
I wish I knew too. Trust me, I've been doing this 20 years and I still can't guess where the rate's going to be.
And the thing that they don't really, that most people don't understand, that mortgage rate is a part of the general rate that is available for every investor out there. It starts from the Federal Reserve, goes down to the mortgages and then cars, right?
Correct. And again, yes, it definitely has a little bit of correlation between them, but rates, they're always going to go up and down. There's no way you're going to say, I'm going to time the market and buy, exactly at the market. Because when rates start pushing down, values start pushing up again.
Exactly.
Okay. And when rates are a little bit higher, where people believe like right now rates are higher, right now is the better time. Why? You have less people wanting to buy, and you have more people getting advantages with sellers to be able to get closing cost credits.
This is the best time
which
to buy
you
right
wouldn't be able to. Think about it. When the pandemic hit, there was no asking for credits. There was zero credits. In fact, you actually probably had to give the customer, the seller, $10,000 above whatever.
was the case at that time.
10,000,
That's
20,000, 30,000, 40. I heard people giving, their firstborn, if they would take it. I swear, I was
No,
like,
I heard like a god
People
of
were
real
crazy
estate.
that time.
The god of real estate was just like super happy, independent. It's like giving everyone homes and money. It's like, wow.
yeah.
Wow.
So it definitely was, and like I said, it that was a new experience for me as well. Just listening to customers wanting these houses and putting multiple offer situations, and we're talking about not 2 or 3 or 4. We're talking about 20 and 30 offers going into houses, on every single one. Why? Because people were moving out of the state, because they were able to work from home. Well, if I could work from home, why am I going to live in New York? Why am I going to live in Cleveland? Why am I going to live, wherever? That's not Florida. Let's live in Florida. Let's live in, the happiest place on earth.
We welcome everybody.
Correct, yeah,
See,
Florida.
our houses just went up because of everyone. Thank you, guys.
Yeah.
Thank you. Thank you so much for not affording the houses.
Yeah.
Well, let's retreat back to
Yes.
Florida,
Yeah.
to Florida again, and I want to touch on a topic that we really get a lot. Me and Leo, as the active realtor on the street, we're dealing mostly with condos, and you know what? Condos is the big party here in Florida, and we get lots of buyers that really struggle to finance that. Can you touch on this?
Just Florida alone, you're talking about well over 1.5 million.
1.5 million
in Florida alone, in condos, just in Florida.
That's crazy.
And out of the 1.5 million, a little bit over 500,000 are just here in our area, in our Broward, Miami area.
Which goes to tell you guys, Florida is condos.
Right.
It's mostly
that's
condos.
condo living.
Yeah, mostly
It's
condos.
definitely condo living. It's wanting to live by the water, wanting to live by the beach, or even further west we go.
So why we're struggling to finance that?
So
If it's the majority, it should be the easiest way to finance.
So it's not that there's a struggle. I never call it a struggle. It's we are now running into where most of these condos are becoming of age. Okay.
Yeah.
Where since we have that abundant amount of condos now becoming of age, most of these condos have to get new certifications, especially condos that were built, before 1994.
40 years.
Exactly. So that's where the 40-year recertifications come in, because they want to make sure that, things are back up to code for future hazards.
Right.
Whether it be electrical, whether it be, catastrophic, unfortunately, like hurricanes and things like that. So that's where changing windows to impact windows, changing electrical cables, to make sure they're within code of today's
How does
market.
challenges affect as a lending?
Exactly.
So with lending, that's where budgets come into place. And you hear us talk a lot about how important the budget is. The budget is what basically is all the expenses that the building incurs on a yearly basis: insurance, maintenance, electricity, water, cable, and then not to mention the amount of items that need to be fixed on a daily, monthly, yearly, and study basis, where they're going, a roof may have 10 years life expectancy. That you want to make sure you don't get to that end point where there's not enough money to be able to cover that. So that's where the budgets come in. And here in Florida, you have to have a minimum of 10% in reserves of its operating expense.
Correct.
That means over and above all your expenses, it's money that you're holding on to, saving, investing through the association in order to make sure that you have money in the future to avoid any future assessments or larger assessments.
And
And that's what makes it a little bit not. I never like using the word difficult. It's just it is an obstacle that we have to.
I would go with challenging.
Challenging.
It's
Okay,
challenging.
not even an
Super
obstacle.
challenging.
But
I agree,
some
challenging.
condos are impossible to finance, though, right?
Yeah, it's impossible.
There is zero condos that is impossible to finance.
Okay.
But is there condos that is not financeable?
No, That's what I'm
All
saying.
condos financeable.
All condos are financeable. Now, are they financeable through conventional ways? Conventional loans.
Conforming
Fannie
loans.
Mae, Freddie Mac, FHA, VA. Possibly not.
So let me make it harder for you. Let's say now I have
Likes
a
to
buyer.
make it harder for you.
Exactly. I want to make it harder. And now, me as an agent, I have a buyer and tell like, hey, George, we have a buyer. We want to get him pre-approved. But the condo have no reserve.
Okay.
Can you
so
finance
there?
it?
Yeah, absolutely. There's different programs. We have what's also called non-warrantable condo lenders that basically will lend on any condo.
What's
Doesn't
going to
matter.
take to finance the no reserve condos?
So it usually takes a little bit more down payment, just only because remember, these are not backed by government loans. These are not. These are backed by investors that know that the housing market is still very strong and always will be very strong. But so they create these funds to be able to allocate towards these purchases. So it's doable.
What if I got you a buyer and the condo have zero deductible insurance?
Again, that goes under the non-warrantable condos. These are these are condos that not every lender can do it, and that's where the best part about my job as a broker is that I can find that bank that's willing to do that job.
Okay, that's good. That's nice clarification.
I'm not gonna touch the bill because it's annoying, but I'm still gonna interrupt you.
Well, if you give me $50, I will give you one power. Okay, well, just one for free.
Okay, got it.
Go ahead.
All right.
Non-warrantable. I do understand what you're talking about, but I want our audience definitely not in line with
What's
what
that mean?
non-warrantable.
Exactly. Not everybody understands what that means. Well, those are the ones that don't fit within the conventional box.
So those doesn't get bought by Freddie Mae and Fannie Mae?
Fannie Mae and Freddie Mac. No, they don't get bought by them.
Okay, so it's
They are-
mostly private investors.
They are private investors, private banks. Most banks are private banks. They have investors that hold on to these loans.
Do you
and
do
these
this
properties.
work in your job?
Absolutely,
Okay.
all day long,
Okay.
Okay.
all day long.
And do they call it non-conforming as
Yep,
well?
non-conforming,
Non-warrantable,
non-warrantable is just a condo. The program is non-conforming.
Okay.
Okay.
So the
Okay.
condo is non-warrantable.
So if you're going
Right,
to
right.
single family, we can use the non-conforming word, maybe. If we call it like just for a condo, that's how it is?
No.
Okay.
That could work on single-family homes, townhouses. It could be due to the property. It could be due to the borrower to go to those routes. So there's all different ways to get the borrower into the property.
Okay. That's
This episode is really deep, even for me. And when it comes to lending, I do have a good amount of knowledge, but I still get confused sometimes. And whenever we're talking about condos, maybe I'm a little bit now, more efficient in condos because of you. Thanks to you.
Appreciate that.
You're teaching me a lot every time. But it still feels like it's always good to go and find a single family house and just, have a peace of mind.
But not everybody is about wanting a single family home. Some people don't want the maintenance, the having to take care of everything. A condo is exactly that. They take care of everything outside of your four walls.
Correct.
You're only in charge of your four walls inside. Everything else they take care of. The maintenance, the landscaping, the security, the
Insurance.
painting, the insurance, everything.
I
Everything is
agree.
taken
I
care
feel
of.
like condo is the peace of mind more than single family home. That's my
It's
opinion.
less headache.
It's a less headache,
Right,
yeah.
right. It's less. It's
Yeah.
less. It's less having to do yourself.
Exactly.
When you're in a single family home, you're taking care of everything. You're taking care of the lawn. You're taking care of the pool. You're taking care of if you have anything that happens, anything and everything, you're taking care of.
Okay.
As a homeowner.
Financing those type of properties is definitely easier, though, right?
That's when you say easier. It
less
doesn't.
challenging. Less challenging. Let's choose something.
It's not.
Less
It's not that,
challenging.
like I said, no. I've been doing this for so long that it doesn't. To me, whether it's a condo, whether it's a single family home, whether it's a townhome, it just means for me the customer trying to get the customer into that property.
I
what
give
if no
him
matter
that.
what it is?
It's less probably less challenging for us with throughout the whole
Correct.
transaction.
Yeah.
But for him, taking care of that financing
Yeah.
part only, it all feels the same.
He's more focused in this part only,
Right.
and he want to make it
Right.
happen. Just make it happen. However, that's going to
Right, exactly. I just look for the way to make it happen. It's still a loan, and my job is to get you from point A to the keys.
So
Point B.
let me give you an example. I love examples because people love example as me and they understand it more. So let's say I'm a buyer. Tomorrow I woke up and said like, oh, I want to buy a condo. What is the first thing I have to do as a lending? I mean, as financing.
After calling you or me.
Calling me then. That's it. You call me.
I mean, like call you. I'm already with a financing thing. I find George. Oh, George, how are you doing? I need to buy a condo.
Okay.
What is the thing is going to stop me?
Nothing's going to stop you. That's where we're going to find out exactly what you're looking for in a condo, what type of property you're looking for, and then we try to get you approved for that type of property and explain, how you're going to go about that. So there's nothing that catches you by surprise when you're in the process.
Mentioning surprise, I know like I was keeping this for later, but since you mention it, I was having my client told me the story about one of his friends. He almost had the keys. Everything was cool. Going to the closing table.
Story of our lives.
Almost have the keys, and I feel what
we hear
he's
these
saying.
stories all day long.
And come out, they didn't cover the flood insurance because the map just come out last month for the flood zones, and it's come out this condo in the flood zone, the new flood zone, and they're not covering the flood insurance. The lender didn't mention any of this before, so now the buyer, he have not enough money to cover all this, and he couldn't close, and he lost the home, and he maybe lost some of his deposit as well for
I highly doubt they would have lost their deposit because it has to do with the condo not having the flood.
Out of the deposit,
but
he
again,
lost
you
the
never
home
know.
that he was always going to take the keys this morning, afternoon. But
And that's the challenge with us is that even though, like you said, you're learning a lot, I learn a lot every day. Every day, our guidelines change. Every day,
That's our profession, it's just learning.
Our rules, regulations, things change. Condos, insurances, go from, where I've seen types of where insurance had this X amount of coverage within our contract. That master insurance policy has expired. They renew and they remove stuff off the insurance.
okay,
So that can change.
And just out of the sudden, they show it up.
Right, well, it's not all of a sudden. It's because the association is on their own working to try to get the best thing for their building, but not necessarily always the best. And like you said, with flood, that would be a conversation that I would say, at that point they may have to start, talking to the association. Hey, you're in a flood zone.
but this thing should not wait till the last day of closing. I mean, like the lender that's sort of problem of the lender didn't mention this at all to the buyer.
Right. And again, I can't say, we don't know exactly where, there was
the catch.
Where was the problem in that particular situation. Like you said, it changed flood zoning. So they could have checked it beforehand. It wasn't in a flood zone. When the last underwriter goes to check, hey, where's the flood insurance? Now they checked it again, and now it's in a flood zone. And now the association may have not had flood for that year because they're in the middle of the year. You don't start doing assessments of what's needed for the budget till the following year. Whatever's already for this year is already done.
I agree.
And approved. And again, there's so many different things that could have happened. I never talk about another lender. All I do is just rescue the loan if I can.
Are we going to talk about the closing costs later in the episode? Or
No,
okay, so,
we can't talk about
so
it now.
since we mentioned this, and this thing was sort of the closing cost when the insurance and all this. So just for a buyer to be like clear and know what he should expect, what is the closing cost?
So closing costs entail of usually from the lender standpoint, it could be, the underwriting fee. That's basically it. Other than that, it could be if the lender's charging any points up front or not charging any points up front. Those are basically the first section that you're going to see. After that, then is your title company fees. That's your recording charges by the county. Your title company fees are the title company that checks the property to make sure it's free and clear and eligible for you to buy, to make sure there's no other outstanding loans by the time you're actually going to close on it.
Insurance.
Then you have your recording charges by the county to record everything under your name. And then it's your taxes and your insurance.
And what about the appraisal as well?
Appraisal, that's a third party.
Okay, third party.
That's a third party.
Okay.
Yeah.
I want to veto something here.
Sure.
Go ahead. Not really vetoes.
No more interruption.
No,
You're
no,
using
no,
a lot of
no.
interruption. We have 3 left.
Okay, don't count it as an
Oh,
interruption.
it was 5 in total. Thank God. I
in
thought it was 5 each. I was like, wow.
No 5 in total. You're using 1, me 1.
No 5 in total.
Thank God.
But you did
I'm
mention.
going to charge you if you're going to use
So
it.
you mentioned something about interest point, and I know lots of people doesn't know that. Some of them do. Can you elaborate more? What's interest points, and what's the relation to seller concession, and what seller can provide in that area?
Great question.
So those are 2 different things. One is
No, I'm just
points.
putting you a hook, so you
And
can't
that's
talk
fine,
about
and that's
both
fine.
of them.
So points are what a lender can charge to the borrower for maybe obtaining that particular rate, to buy down that rate. Like, let's say currently a customer qualifies for 7.1, but they would like to go to 6.5. Well, you can get to 6.5. This is going to be the cost. So whatever that cost is, that's the points that it's going to charge you. The amount of fee, the percentage of that loan that it'll take to get you down to that interest rate that you want.
Is that the same thing they call discount point?
Yes.
Okay.
Yes.
Okay. And the other one that the seller can provide. what's
So
that?
the seller can provide closing cost credits, and that's what I was saying right now is the best time for that, where the seller is giving you credits towards closing costs. You can use that a number of ways. You could use that towards all the closing costs we just talked about, title company fees, recording charges, taxes, and insurance, towards your closing costs. So you have to essentially bring less to the table. Or you could even use that to buy down your rates through 2, 3,
To a
1
one buy down
buy
or
downs.
something.
Right.
Okay.
Okay.
And
So
that's
it's
to
not
bring
like
down
the
your
seller
rate.
has to determine what the closing cost is going to.
No,
He doesn't have
the
to
seller
determine that.
has no idea. Usually, that's something that you and I as a team, we work together. Hey, how much we're going to ask from the sellers. This is what it'll translate for the buyer. And that's how we figure out that number.
And I just want to make it nicer for the listeners because it just went like this. If you are really complaining about the rate today and you say like, oh, 7% is too much. You just said you can go to 6. You can buy it and go to 5 if you want.
Absolutely.
Whatever you want, you can do.
Yeah,
It's
you
not
can
about like just 7 is fixed.
Right, it's not. That
This is gonna cost more.
Exactly.
It does.
And I'll show you, now there's always a cost correlation to that. With that cost, does it make sense? Sometimes it can. Sometimes I say it doesn't, especially if we're right now going to be able to, like I said, rates we do believe are going to come down. It might not be beneficial to pay all that money to bring down the rate to then refinance again. And we watch out for the borrower to make sure they're not spending more money than they should if it's not going to be cost efficient for them.
Okay, makes sense. Makes total sense now.
How about we shift gear a little bit?
Let's go.
That's too technical.
Okay.
Let's have some fun.
I
have a
bet
headache.
someone has a headache of
I do.
numbers already. Okay. So, we keep hearing about pre-approval, pre-qualifications. I want to nail that down once and for all. What's the difference between this and that? What's the
Sure,
pre-approval, pre-qualification? And then, if you can explain why pre-approval is really crucial in the beginning of the home buying process.
So let's start with pre-qualifications. A lot of people think, like you said, they're the same thing. They're really not. A pre-qualification is something that in passing it could have been us talking, just basic, understanding what your situation is as a buyer. You're telling me what you make. You're telling me how much money you have in the bank. You're telling me what kind of credit scores you have. Well, you can do a pre-qualification based on that, just based on the conversation. But if there's not any paperwork to back it up, that's where it becomes tricky. Then you want to make sure it's a pre-approval, because with a pre-approval, you're actually reviewing documents. You're actually reviewing the customer-specific documents. Because if they're just telling you what it is, the customer doesn't know if they're telling you based on self-employed income, based on bonuses, based on money that they may be getting from under their mattress or from home or from a family member or a friend, where all that plays a role in your pre-approval to make sure that we walk you through the right steps to get you to that point where there's not going to be any hiccups when you actually put in an offer on a property.
So would you say it's pre-qualification is verbal talk?
It could be verbal.
First step.
Yes, Correct.
The first
Pre-qualifications versus actually submitting your documents, taking a look at your credit, making sure we look at everything that can possibly that we can make sure we're ahead of this every step all the way to the day of closing.
Okay, so now I really need your help, seriously. So for a lot of buyers, just because they think, I don't think I can buy a home, they just cancel the whole purchase idea completely from their mind. This is what I see every day, but they're not realizing that is no. Most of you guys who cancel this idea, you can afford to buy a home. So, and they bother to call me as an agent or to call a lender to ask. So just give me a math play here. How anyone watching us now, he can just qualify himself, and I said qualify, not approve or anything, to see like, can he call an agent or a lender or not? Just give me like a numbers, what he should have.
And with that, we're gonna stop here for today. There is so much information, so much numbers, and I don't want you to be overwhelmed for one episode. So we're gonna cut here, and we're definitely gonna finish in the next episode, and we have a lot to cover.
And if you're asking what have left to the second part, let me tell you what we're gonna talk about. We're gonna talk about the programs that could bring you to the closing table with $0. Program as $50,000 for free, $35,000 for free, or $7,000 for free. That's it for now. So again, if you want to reach out as an agent or George as a lender, all the information down below. And as well, we're talking with agent in the second part. Agent, if you want to have a clear idea how to work with a lender, what is the most important thing, stay tuned for the second part. And that's it.
That's it. Thank you, guys.